inflation target, that is optimal for economic growth. But inflation above 3% is bad for our economy. And negative inflation is also bad for our economy. So having inflation between 1 to 3% is key to economic growth and economic stability. So that's very important. So the Bank of Canada, that's their target. The Bank of Canada's main job is to keep inflation between 1 to 3%, but their overall target is 2%. So that's very important for our economy. So we'll learn about the Phillips curve today. So I'll post this PowerPoint after we're done with this. So there is a short run trade-off between inflation and unemployment. So the higher inflation can reduce unemployment. So higher inflation can reduce unemployment in the short run. However, this does not work in the long run. Higher inflation in the short run can lead to more demands and therefore more consumer purchases, thereby needing more workers. Then in the long run, people are unable to afford the higher prices, and then the economy goes into recession. So right now, basically, with inflation near 8% last year. So that's kind of what happened last year, where people just were not able to afford the higher prices, and the economy is going into a potential recession. And also this hurt stock markets. So 2022 was the worst year for stock markets since 2008, roughly. So because of the high inflation environment. So the high inflation was not good for the stock market because the Bank of Canada was raising interest rates to bring down the high inflation. And this stopped a lot of borrowing because borrowing costs went through the roof due to the high interest rate costs, and people invested less because they usually invest with borrowed money, and the rate of return they would get on their investments would be less than the borrowing costs. Therefore, investing makes no sense if the cost is higher than the return. So that's what happened last year, 2022. So this is what happened in 2022. So that's why the stock market was down in 2022. And so unemployment and inflation. The natural rate of unemployment depends on various features of the labor market. So yeah, the natural rate is based on the union power, efficiency, wages, effectiveness of the job search, and minimum wage laws. And the inflation rate depends based on the growth of the quantity of money and interest rates. Unemployment and inflation. So like I said before, higher inflation in the short run can reduce unemployment. And if policymakers expand aggregate demand, they can lower unemployment, but only at the cost of higher inflation. The problem with, so aggregate demand is another term for GDP, economic output. So the problem with growing the economy is that it produces inflation. So the economy can grow and jobs can be created, but there will be higher prices and higher inflation, which is the cost of economic growth. Unaffordability is the cost of economic growth. That is why we need contractions / recessions to bring prices down again. So the benefit of contractions / recessions is that everything starts to become more affordable again, because prices start to because inflation goes down. So that's the benefit of recession / contraction. However, there's not a lot of benefits to recession / contraction, but that's one of them. So if they contract aggregate demand, they can lower inflation, but at the cost of temporarily higher unemployment. Phillips curve. So the Phillips curve is what shows higher inflation causes lower unemployment in the short run. So this is the short-term fix. So if they want unemployment to come down in the short run, they can increase the inflation rate. So this is a short-term fix. However, they cannot keep doing this because in the long run, this doesn't work. So this might be a short-run solution, but there needs to be a long-run solution. So in this case, so like I said, higher inflation in the short run, lower unemployment. The greater the aggregate demand for goods and services, the greater is the economy's output and higher is the overall price level. Higher level of output results in lower level of unemployment. So here, the problem with right here, like I said, with more output, higher prices. So that's the problem with growth. So there's a positive relationship between price level and output. Yeah. And then also, like, as prices go down, output goes down. So as you see here, the aggregate demand curve shifts right here. And this would increase prices, increase output when aggregate demand curve shifts right. So expectations. So the Phillips curve provides policymakers like ways to use inflation to reduce unemployment in the short run. So long run Phillips curve. In the 1960s, few economists concluded that inflation and unemployment are unrelated in the long run. So the long run Phillips curve is vertical at the natural rate of unemployment. So monetary policy can be effective in the short run, but not in the long run. So you could increase the money supply and reduce interest rates in the short run to grow the economy. However, this doesn't work in the long run. So the US has tried to grow the economy through increasing the money supply since 2008. However, it has only worked in the short run, not long run at all. So this is what happens in the long run. So unemployment doesn't change at all with increases or decreases in the inflation rate. So it doesn't matter what the inflation rate is in the long run, the unemployment will stay the same. So it doesn't matter what the inflation rate is in the long run, the unemployment rates will stay the same. So that's the truth here. So when the Fed is the US Federal Reserve, they print the money. When they increase the growth rate of the money supply, the rate of inflation increases. So in the long run, going from low to high inflation, it doesn't matter in terms of unemployment. The unemployment remains its natural rate in the long run. So long run unemployment equals the frictional plus structural plus cyclical, and no influence from inflation. So even if aggregate demand increases like this, like even if aggregate demand shifts right, the output will remain the same in the long run. And the unemployment will remain the same in the long run. So natural rate of unemployment is what the economy will get to in the long run. And it's not constant over time. It could change based on technology and job changes. Monetary policy cannot change the natural rate of unemployment, but other government policies that strengthen the labor markets can. So I'll ask all of you this. I think I'll rephrase this question. Like how can you use the short run Phillips curve and the long run Phillips curve in investing or policy making? So I put that in the chat. So what I'll do is I'll put it on the slides too. So I rephrase the question a bit. Like, how can you use this information for your benefit in investing, policy making, or any part of your life?
Well, if you're in a recession, it will be followed by economic growth. So that's when you want to invest. But if you're in, I don't know if you'd want inflation to take your investments out, but basically like you can use it to track the economy to know when to put in when it's low or when to take out when it's high.
Yeah, that's a good point, Ashley. Yeah, exactly. So yeah, when you see an expansion coming in the economy, when you think you're at the trough of the economic cycle, you can invest. That's a good strategy. Does anyone else have any points for that?
I think I would agree with what Ashley said and just add, because of pyramid scheme, I think you're not allowed to pull out during inflation. That will actually aggregate more inflation. So that's the only kind of thing that I want to mention. So
Yeah, that's a good point. Yeah, I think with thanks, Alexander. Thanks, Ashley. Does anyone else want to add? So great points. So I'll add to that too. Low inflation, like right now, inflation is going down. So that is good for investors. So the Bank of Canada raised interest rates to bring down inflation. However, raising interest rates is bad for stock markets. So the stock market, like I'll let everyone know about this, like it's the stock market is almost 100% correlated with the interest rate. So what happens with the stock market is that when the interest rate goes down or is very low, the stock market goes up. Very high correlation. So it's very correlated to the interest rate. So the stock market price has a high negative correlation with interest rates. So, right, so if the interest rate is likely to go down soon or in the next few months, investing is a good option. So last year, interest rates went up substantially and the stock market did very poorly. So last year interest rates went up substantially and the stock market did very poorly. I anticipate that interest rates will go down considerably this year because inflation is getting under control. So inflation is starting to come down. Inflation is starting to come down. And the Bank of Canada only raised interest rates because inflation was too high. So this is extremely beneficial for investors. Investors will benefit with lower inflation and lower interest rates. So yeah, lower inflation, lower interest rates are good for investors. And the stock market is, since 2023 started, it's been doing better. A lot of the stocks have been doing better. So that's connecting this to the real world here. So the Fed's ability to create unexpected inflation exists only in the short run. So the unemployment rate is natural rate of unemployment minus A of actual inflation minus expected inflation. So this shows that the unemployment rate is related to the natural rate of unemployment, actual inflation, and expected inflation. So this is the graph that we showed here. So the expansionary policy would move the economy up along the short run Phillips curve. So the unemployment rate would go down because the Bank of Canada is increasing the money supply, and that would cause the inflation rate to go up. So this would be caused by increase in the money supply. Money supply, reducing unemployment rates, increasing inflation rate. So that's what happens here. And then the long run, it'll shift back, because in the long run, monetary policy doesn't affect that. So here, so this is the Phillips curve in the 1960s. So they graphed out what was happening, and it shows that lower inflation rate, like as inflation rate goes down, unemployment rate goes up. So that's what they showed graphing out the Phillips curve in the 1960s. So 1960s data showed that higher inflation rates correlates with lower unemployment rate. So that they proved, they showed that through the data from that decade. Yeah, so it's pretty clear here. But then when 1970 came around, it didn't really make sense anymore. It just didn't follow that curve. The 1970 data just did not, the 1970 data, it just did not, the 1970 data just did not line up with the expectations of the Phillips curve. So Phillips curve shifts have happened due to changes in expectations in the past. And then also due to, so expectations are, you expect the economy to do better over time. That would increase output. If you expect the economy to do better, the economy will do better. So expectations are a big thing. Like if people are more confident in the economy will do better. So expectations are a big part of the economy. And then also the short run Phillips curve shifts because of shocks to aggregate supply. So that's something that happens here. And then supply shock happens with the firm's costs. So in that case, if costs go up for a firm, they can supply less. Yeah. So in this case, there were supply shocks in the 1970s with oil, and OPEC had, so what the government had to do was to increase the money supply to fight unemployment. So they could increase the money supply. That's the first point. So this would be increasing the money supply. So this is, so they, or reducing the money supply. Reducing the money supply to get rid of inflation. Increasing the money supply to get rid of unemployment. So they could have increased the money supply to get rid of unemployment, or reduce the money supply to get rid of inflation. So in the 70s, it did not match the Phillips curve. So the Phillips curve would look like this usually, where like a lower inflation rate, so a higher inflation rate is correlated with a lower unemployment rate. That's the Phillips curve. But as you see here, it doesn't follow this relationship here at all. It has there's no correlation in the 70s. So the Phillips curve did not work in the 1970s because higher inflation does not reduce the unemployment rates in the long run. Yeah, so the unemployment rates and inflation have no correlation in the long run. And this is shown by the 1970s data. Yeah. So the cost of reducing inflation. To reduce inflation, the Fed has to pursue contractionary monetary policy. So they need to reduce the money supply. However, that's going to hurt the economy. And we've seen that in Canada last year through them shrinking the money supply. It's hurt stock markets and hurt our output. So this reduces the quantity of goods and services that firms produce. This leads to a rise in unemployment. So to reduce inflation, an economy must endure a period of high inflation and low output. So yeah, so it's so making products more affordable, there's a big cost to our economy because we're going to have less output. So when Paul Volcker was Fed chairman in the 1970s, inflation was one of the biggest problems in the United States. So he succeeded in reducing inflation from 10% to 4%, but there's a lot of unemployment based on this. And then Alan Greenspan, he was the head of the Federal Reserve in the United States from, I think, 1987 to 2006. So he was in that position for 19 years, I believe. And so he was in that position for a very long time. And he so he was in that position a long time. Paul Volcker, this is what he did during his time as the head of the Federal Reserve. He reduced inflation through increasing unemployment, and then it came back. So unemployment went down after 1982. And then Greenspan, it was mostly inflation was low most of his time, and the unemployment rate came down. So inflation was low for most of Greenspan's time, which is good for our economy, and unemployment wasn't that high. So he seemed to keep everything stable for the most part, except for at the end. So fluctuations in inflation and unemployment have been relatively small because of the Federal Reserve's actions. So yeah, so that's an important lesson, and you can use that a lot in investing. So this will be posted. This will be posted for everyone. And it's a great thing for investing. If you do want to get into investing, the investing in low interest rate and reducing interest rate times is the best time to invest. So if the Bank of Canada is going to announce that they're going to lower the interest rate, that's a great environment for investment. So that's so, and also investing in things you understand is a great thing to do also. That's incredibly important. So that's one of Warren Buffett's key key strategies, investing in what you understand. So make sure you invest in what you understand also. So like industries you understand, if it's like, for me, it's like banking. I understand banking, but depending on what you understand best, invest in that. So we will do another activity and then I'll open up the test. So this is on some of the review and some of the stuff we did today. So let's try this here. Okay. So here you copy. So this will be our activity and we will do the test. Okay, let's get started. So what is GDP? Excellent. Some of the final goods and services produced within the nation's borders in 1 year. So what is not included in GDP? The spending by consumers on illegal items. What is the formula for GDP? E plus I plus G plus I. XN, great job. So what is included in GDP? Well, exports. Good job. Then what is not an approach to calculating GDP? Value subtracted approach. Good job. And then what is investment spending? Spending on plant and equipment. What is not included in government spending? What is not included in GDP? So used goods. What is the largest percentage component of GDP? So consumer, but it's kind of a trick question because government would be the highest percentage in North Korea, for example. Net exports might be the highest percentage in like a tourist nation. Yeah, so it just depends on the nation, but it's usually consumer spending. What's the formula for net exports? Exports minus imports. Good job. Then why are intermediate goods not counted in GDP? Double counting. Good job, everyone. What is the formula for the income approach? Great job. Rent plus wages plus investment plus profits. Great job. And what is true about GDP? Expenditures equal income network. What is included in consumer spending? Pizza bot, great work. Then what is not included? GM car produced in Mexico sold to UK. Then what is included in GDP today 2022? Automobile produced in 2022 held in inventory. What is the problem? What is the problem with GDP? includes money spent on jail/police. Yeah, that, yeah, there are a lot of issues. GDP doesn't factor in a lot of costs, like pollution's not factored in, it should be subtracted. There's a lot of issues with GDP. What country today has the largest GDP in the world? So it's United States, but yeah, it's United States right now. Yeah, but China's coming up. What is nominal GDP? Total sum of all products produced. And then what is the use of GDP? To compare it to other years. Then what is not a use of GDP? Study of the individual. Then when was the study of macroeconomics started? The Great Depression. Then what does GDP equal for a country? Income of the country. And then what is not included in the value-added approach to GDP? Value of raw materials. What model is used for with GDP?